The S&P 500 is a famous stock market index. It's one of the most well-known and widely followed indices in the world. It tracks the performance of 500 big companies in the United States. These companies span across various industries, from technology to healthcare, finance, and consumer goods. Think Apple, Amazon, and Google. These tech giants are just a few examples of the influential companies included in the S&P 500. Many investors see it as a way to measure the overall U.S. stock market. It provides a snapshot of the market's health and direction. It's like a report card for how well American businesses are doing. When the S&P 500 is up, it generally means that the majority of these companies are performing well. The S&P 500 is popular. It's a go-to benchmark for both individual and institutional investors. It has a long history of growth. Over the decades, it has delivered substantial returns, making it a favorite for long-term investors. This makes it attractive for those seeking long-term returns. By investing in the S&P 500, you're essentially buying a piece of America's economic future. When you invest in the S&P 500, you're basically betting on the success of the U.S. economy. You're putting your faith in the resilience and growth potential of American businesses. But remember, investing always has risks. The stock market can be volatile, and the S&P 500 is no exception. The S&P 500 can go down too. Economic downturns, political instability, and global events can all impact its performance. It's important to understand those risks. Diversification and a well-thought-out investment strategy can help mitigate some of these risks. Make sure they align with your investment goals. Whether you're saving for retirement, a major purchase, or simply looking to grow your wealth, the S&P 500 can be a valuable part of your investment portfolio. Educating yourself about the market and staying informed about economic trends can also help you make better investment decisions. With the right approach, investing in the S&P 500 can be a rewarding experience, offering the potential for significant growth over time. Remember, investing is a journey. It's about making informed choices and staying committed to your financial goals. The allure of the S&P 500 lies in its ability to represent the strength and dynamism of the U.S. economy. It's a testament to the power of American enterprise and innovation. ETFs are like baskets of stocks. They trade on stock exchanges. World ETFs are special. They give you a piece of companies from all over the world. This is called diversification. Diversification is like not putting all your eggs in one basket. If one market is doing poorly, another might be doing well. World ETFs spread your risk. There are many world ETFs to choose from. Some focus on specific regions like Europe or Asia. Others cover the entire globe. It's important to do your research and find the one that matches your investment strategy. Investors often face a tough choice. Should they stick with what they know? The familiar U.S. market with the S&P 500 can be comforting. Or should they explore the world? World ETFs offer the potential for higher returns in faster-growing economies. There is no easy answer. Both options have pros and cons. The best choice depends on your risk tolerance, how long you plan to invest, and your overall financial goals. It's like choosing between a relaxing vacation at home or an adventurous trip abroad. Both can be rewarding in their own way. The S&P 500 is a powerful benchmark. It has a long history of solid returns. Since 1957, it has delivered an average annualized return of around 8%. That's impressive. This means if you had invested in the S&P 500 50 years ago and held on tight, your money would have grown significantly. Of course, past performance isn't a guarantee of future results, but it does give us some clues. The S&P 500 is like a reliable car. It might not be the flashiest or fastest, but it gets you where you need to go. Navigating the world of ETFs, diversification is key. In the world of investing, diversification is a fundamental principle that can help mitigate risk and enhance potential returns. By spreading your investments across various assets, sectors, and geographical regions, you can create a more resilient portfolio. World ETFs offer something different: diversification. These funds allow you to invest in a broad range of assets from different countries and industries, providing exposure to global markets. This means that your investment is not tied to the performance of a single market or economy. They spread your money across many countries and companies. For instance, a world ETF might include stocks from the United States, Europe, Asia, and emerging markets. This geographical diversification can help protect your portfolio from regional economic downturns. This reduces your risk if one market takes a hit. If the economy in one country falters, the performance of stocks in other regions can help balance out the losses. This way, your overall investment remains more stable. Think of it like a safety net. Just as a safety net catches you if you fall, a diversified portfolio can cushion the impact of market volatility. It provides a layer of protection that can help you weather financial storms. If one part of the net weakens, the other parts are there to support it. This interconnectedness ensures that your investments are not overly reliant on any single asset or market. It creates a balanced approach that can enhance long-term growth. World ETFs can be especially appealing to investors worried about the U.S. economy's future. With concerns about economic instability or market fluctuations, diversifying globally can provide a sense of security and potential for growth in other regions. However, diversification isn't a free lunch. While it offers many benefits, it also comes with its own set of challenges. Managing a diversified portfolio requires careful planning and understanding of different markets and assets. World ETFs can be more complex than S&P 500 funds. They involve multiple currencies, regulatory environments, and economic conditions. This complexity means that investors need to do their homework and stay informed about global market trends. You need to understand the specific countries and companies they invest in. Researching the economic health, political stability, and growth potential of these regions is crucial. By doing so, you can make informed decisions and optimize your investment strategy. The performance race. Can world ETFs outpace the S&P 500? Now for the million-dollar question, which investment performs better? The answer, like most things in finance, is complicated. It depends. In some periods, the S&P 500 has been the clear winner. In others, world ETFs have taken the lead. There's no consistent pattern. Remember, past performance is not a guarantee of future results. The best predictor of future returns is, well, the future. And that's impossible to predict. Risk and volatility. A balancing act. All investments come with risk. The S&P 500, while generally considered stable, can be volatile. It can experience sudden drops, especially during economic downturns. World ETFs can be even more volatile. Emerging markets, in particular, can be unpredictable. But this volatility can also lead to higher returns. It's all about finding the right balance for your risk tolerance. If you're easily spooked by market fluctuations, the S&P 500 might be a better fit. If you're comfortable with more risk, world ETFs could offer greater growth potential. Tailoring your strategy. Finding the right fit. There's no one-size-fits-all answer to the S&P 500 versus world ETF debate. The best choice depends on your unique circumstances. Consider your time horizon. If you're investing for the long-term, say for retirement, you can ride out short-term market swings. This might make world ETFs more appealing. Think about your risk tolerance. Are you comfortable with big ups and downs? Or do you prefer a smoother ride? Your answer will guide your decision. The verdict: it depends on your individual goals. So, which is it? The S&P 500 or world ETFs? This is a question that many investors grapple with when trying to decide where to allocate their funds. Both options have their unique advantages and potential drawbacks, making the decision a bit more complex than it might initially seem. The truth is, there's no right or wrong answer. It really comes down to your personal financial goals, your risk tolerance, and your investment timeline. What works for one person might not be the best choice for another. It's all about finding the right fit for you. Are you looking for steady growth within a familiar market? Or are you willing to explore opportunities on a global scale? These are important questions to consider. Both options offer the potential for growth. The S&P 500, for instance, has a long history of providing solid returns, representing some of the largest and most successful companies in the United States. The S&P 500 provides exposure to the U.S. market, which can be a great choice if you believe in the continued strength and stability of the American economy. While world ETFs offer global diversification, this means you can spread your investments across various countries and industries, potentially reducing risk and capturing growth in emerging markets. The key is to understand the benefits and drawbacks of each approach. For example, while the S&P 500 might offer more stability, it also means you're putting all your eggs in one basket, so to speak. Then, make an informed decision based on your investment goals, risk tolerance, and time horizon. Are you investing for retirement, a major purchase, or simply to grow your wealth over time? Each goal might require a different strategy. Remember, investing is a marathon, not a sprint. It's important to stay patient and not get swayed by short-term market fluctuations. Consistency and a long-term perspective are key. Choose a strategy you're comfortable with and stick with it for the long haul. Whether you opt for the S&P 500, World ETFs, or a combination of both, the most important thing is to stay informed and make decisions that align with your personal financial goals.